Risk management is something you guys have heard me say a bunch of times in these last few topics I've just presented to you. Using proper position sizing, using stop losses, and having a strategy that you have back tested and demo tested with and you know it works out, that all plays into the role of risk management. Your job as a trader is to protect your capital by managing your risk when you're trading. This makes risk management the most important concept in trading. I would say it is 90% of what makes profitable traders and profitable strategies is a strong risk management plan. Without risk management, you are just gambling. That is a fact. You are just gambling away money. You are just, maybe it'll sell, maybe it'll buy, who knows? You are just playing roulette with the 50-50 chance that the market will go one way or another. And that is not smart if you don't have risk management in place. The definition of risk management comes down to protection of trading capital by controlling losses, keeping the amount of the capital risk small and managing drawdown through the use of stop losses, and then managing your wins to ensure that they are outweighing the losses. This will allow you to have account growth. So like I said, you can have losses. Losses are okay. It doesn't matter if you lose. As long as your risk management is good enough, your wins are bigger than your losses consistently, you will still make money. The general rule of thumb for how much you should be risking per trade is somewhere between 0.5% to 2% of your available capital per trade. You have to remember though that is per trade, so make sure that when you are taking multiple trades that you are aware of how much percentage you truly are actually risking. So if you are risking 2% per trade but you have 10 trades running, you are actually risking 20% of your account, not just 2%. So make sure that you're being careful with how many positions you are taking. On average, I find that most people trade 1% consistently, but there is some flexibility here with the 0.5% to 2% per trade. I have Euro USD here pulled up on a chart on TradingView just to give you an idea of what risk management means when it's applied to the chart. So as you can see, I have a very basic trend line marked up here and I have a reversal pattern labeled. You don't need to worry about this. Don't get stuck on this, guys. This is just to show you how you would potentially come into a market and maybe you saw this happen and this was your markup, right? So hypothetical. What I want you to focus on more than anything is just this break of this trend line. And we see that the candles are forming here. Say that we're looking at the market when this is happening and we're like, oh, I want to take a sell here. We broke a trend line. We have a previous reversal pattern. Let's get in this sell. What you'll do is you'll come over to your short position tool and you're going to mark up your candle. You're always entering in at the close of candles. You don't want to enter in while they're still forming. You want to wait till the close of them. So at the bottom of this candle, what I want you guys to focus on here is the risk management of the trade. So when you pull up your short tool, it automatically just does a one-to-one type of situation. So your middle line here goes under your entry candle. So that acts as your entry line. Where would you be entering? Then you want to place your stop loss. Your stop loss, in this case, we would want it to be just above the trend line area in case the market decides to come back up and retest it. So that way you're still safe, but you're not too close that you would get stopped out. So we'll go kind of right above this little wick area up here where you're still just slightly above the trend line, but you're not all the way up here. So we have our stop loss placed. Now we want to look at where would we want our take profit to be. You guys can see I just marked up a little zone here, and that's just because when I was looking at it, it was a previous support zone. And at the time that we're pretending we're getting in the market here on this candle, the next logical place for the market to go to was this zone. So I mark it there as my potential area where I think the market will go. So that's where I will drag our short position tool to, and I will target this as our take profit. So now you can see on the tool that we have a risk to reward ratio that is given out. It is 3.84. What that means is if I risk 1% of my account, I would lose 1% if the market comes up here. But if the market comes down here, I will make 3.84%. That is a good risk to reward. You could potentially make 3 times more than what you are risking. So that is good. That is something that you could say, this looks like a good trade, and now let me continue on to my position size calculator, find out my lot size, and enter into this trade. This would be a trade you would say this is worth the risk. If, for instance, you had put your stop loss way up here, and all you wanted to do was go here because you wanted to target this wick or something. I don't know what you were thinking, but that's what you wanted to do. This would not be a good risk to reward. You would be risking 1% of your account to only get back 0.29% of what you risked. That is too much of a risk for a very little gain. So you want to avoid trades like this. If you find that the opportunity where you're entering is that's all you can get, then you should not take that trade. Don't be afraid to skip trades. You do not have to take every entry in every single setup that you see. Some of them may not be worth it, and it's okay to skip them. It is better to skip a bad risk to reward trade than to enter one and lose. I'm going to be reviewing with you the importance of a trailing stop loss and securing your profits. Trailing stops allow you to secure your profits on the full position size that you have open while keeping the trade open and not having it hit what you would have predetermined as your take profit. You may have a take profit area in mind, but you wouldn't have it set to be hit. You would allow the trade to remain open, and you would be moving the stop loss along as the trade goes in profit, securing the profit. Here is an example of what this would look like. You would enter into your position here. This would be your original stop loss down here, and then you can see as the market pushes up, pulls back, and then gives a strong candle to confirm that you are just in a pullback. That is a confirmation that the trend is still going your direction, and you could look to potentially move your stop loss to here. And then you can see you get another push up, and then again after a pullback, confirmation that the trend is continuing in the direction that you had hoped for. You could then move your stop loss from here to here. You can see that that step pattern has been forming. That step pattern of market structure that we have talked about previously, this is where you are going to be placing your trailing stops, just under those areas, those steps that create market structure. That is typically how you would trail along. So looking back at our Euro USD example that I just showed you guys for proper risk management, I'm going to kind of run you through what a trailing stop would look like on an actual markup. This is not an actual moving market right now at the time that I'm recording this, but I'll do my best to make it mimic it. So pretend that this red line here is our stop loss. This yellow line is our entry on our entry candle here. And we're going to pretend that this green line is our live moving market line for price. So let's pretend it's moving down and it's going down, as we can see all of these candles printing and going down. And we get to like this point here and you're thinking, okay, the market has moved pretty far from my stop loss. I think I'm ready to secure this trade and move it to break even. So that would mean you would move your stop loss to just slightly in profit, just a little bit under your entry line. If you guys can see, I'll zoom in. It goes slightly under where your entry is, just enough to cover any commission fees or spreads that you may have. So you want to move it just a little bit under. And then you are going to let the market keep going. So you just let the market keep moving. Price is moving, kind of pushes up a little, kind of bouncing around, and you're like, I don't really love it, came a little close, I'll just keep waiting. Because at this point, your trade, where it's at, here is completely risk-free. You cannot lose anything. So you're just waiting until you get a nice confirmation that the market is going to continue in your direction. And maybe around this point where you start to push that low that it made, you're like, I think I'm ready to secure some more profits. Now you're ready to move your trailing stop to secure more profits. So you're like, okay, maybe I like this area here. So you have now secured all of the profits that are made from your entry point to where you put your trailing stop. So everything in here, you will profit whatever that market movement ends up making you. So even if the market comes back and pushes and stops right away, you're okay. You have made money. But the market is continuing. So let's go back to our trade. So market's continuing and it's dropping and dropping and then dropping. And maybe you're like, ooh, it just did another big drop. Let me move my trailing stop again. So now we move it to here under this level. So now you've secured all of your profit from your entry point to this point. Market continues to push and push and push. And maybe you get down here and you're like, oh, market is just dropping. I'm going to move my trailing profit to here. And you now have secured all of the money that would be earned between this price point to this price point. And then you see market comes back up and boom, knocks you out of your trade. That is okay. You have made money. You did not lose anything. You have made everything from here to here, and you have trailed all along. So the point of trailing is to be able to maximize your profits instead of being stagnant with just a set take profit area all the time. So this is the concept of a trailing stop, as well as securing profits. So that way you are risk-free in your trades and you don't have to worry so much about losing, and you can allow them to just run to their potential. Now that you've learned the basic concepts of risk management and the importance of it, you can start to look at how would you create a trading strategy and or system. You need to determine your trading style when you're looking into this. There's different styles. There are scalpers who are usually in the market from a couple of seconds to usually a few minutes, not more than an hour usually. Then there's intraday trading, which could be a few trades within the day. This could be anywhere from a couple of minutes for your trade to execute to potentially the day itself, where it could take a couple of hours or the whole entire trading session or day that you are trading. Then there are swing traders who hold for multiple days. The style trading is totally going to be determined by you. I recommend that what you do is take a personal approach and figure out what your lifestyle will allow you to truly dedicate the right amount of time to. Another thing you need to look into when you are looking at starting a trading system or strategy is the ability to determine the trend direction. Using things such as like a basic 200 moving average helps to determine trend. Market analysis would help with that, or something like crossing of moving averages. You should have something that emphasizes the importance of trend when you are looking at a system. You want to know, are you trading with the trend or are you counter trend trading? For some people who like to use indicators, you can add in indicators that would potentially help you with entries or help you confirm entries. Any additional indicators that would provide confirmations are also a good idea. Things that would look at potential volume in the market, oscillators of price where you would see price movement oscillating, or doing things like technical analysis and working with like trend lines and support and resistance on your own, but like subbing them in as indicators. That could also be acceptable. You want to make sure that you are defining your risk. Once you've figured out all of the things you need to enter into a trading system or a strategy, you want to then figure out, how am I going to risk with this strategy? You should have a way to define when you are entering and exiting a strategy. And you also need to have some sort of stop loss criteria built in. Whether you're using the swing low, swing high, or market structure like I talked about, or whether you're using a fixed stop loss where you are always using the same amount all the time, that is up to you to decide. But this will also help you with back testing. When you go to look at your data, you can see what is working and what is not working and make adjustments to this. Lastly, you need to test it extensively and you have to refine it as needed. Even if a strategy is working for you and you are journaling them, you should still be going back through every couple of months and making sure that something isn't going on that you're missing or that you could perhaps make better as markets are changing all the time. A quick tip about creating your trading system or strategy, I would say to keep it simple. Keep it easy to follow and well defined to help you consistently execute the trades. Don't have a bunch of like, well, sometimes I do this, sometimes I do that. When you're trying to create something in the beginning, you want to have as well-defined rules as possible. Those exceptions to the rules you may add in after you have tested because you have seen it happen enough and you have documented that it has happened enough and you're able to prove why you would make those exceptions. But try to stay very true to your rules. So try to keep it simple, and I would recommend trying to keep it as like easy to follow and clean as possible. Even if you have a decent amount of indicators on, you're somebody who likes a lot of indicators, it's still possible to keep them like well organized and as clean looking as you can. So I think that that is actually something that really helps a lot of people, because nothing's worse than having a very busy chart and being super confused, and then you start talking yourself out of trades or into trades maybe that don't meet the criteria. So try to avoid crazy busy charts or like overcomplicating it. Something like this looks insane, and try to avoid doing this. I know that beginner traders think that if you have 100 indicators on your chart that you're more likely to win, but that is not the case. You can have a very simple chart and still do great with your trading strategy. Backtesting is so important. You need to backtest your strategy. The reasons is because it helps you to determine if you have a winning strategy, and it helps the strategy performance over time. Strategy refinements I've already talked about and I said are very important. The reason is because it helps you to figure out the ideal stop loss, the ideal take profit and locations, and or a set risk to reward or trading time frames. Also, what pairs will work best with it. It helps to aid in the overall development of the trade plan. It also helps with training and practicing with the plan. You get more experience with your strategy the more that you're back testing with it. So that way, when it comes time to using it with a demo in a live market or on an actual live account, you will be very familiar with your strategy and very comfortable with it because you have used it so much already. It will also give you a bunch of data that is very valuable. You can take your data and break it down, and I will show you an example in a moment of how detailed you can get with your data to then further refine it. A couple of tips for back testing your strategy is use the bar replay or the simulation software if you have it available on your TradingView subscription. And you need to be very honest with yourself. You need to mark up all the trades that you have that would fit your agenda, but also putting your stop losses in places that you truly would put them in a live market. Try not to get suckered into the hindsight of being able to see the future of the market, because that's not realistic. And that is where marking up your charts with the replay mode is very helpful, because you can't cheat. The second tip would be to just collect the data, as much data as you possibly can. Don't be lazy here with this. Don't just do like 5 trades and be like, oh, wow, I did so much back testing. You need to really back test. Ideally, you should be looking for somewhere between 6 months to a year at least of back testing data. And I mean like 6 months if you are on the 1 minute to about 15-minute time frame. You should have about 6 months of data if possible. If you are on the 15-minute and higher, you want at least a year's worth of data, because some of those trades will take much longer to play out. You also want to make sure that you do measure the full trade when you are looking at your back testing data. Even if you say, I only want a 1.5 reward consistently, I want to set a fixed take profit, you still should measure the full movement of the trade and when it ends and how it plays out. This will allow you to then go into your data and enter in what we would call a potential profit. And that will show you where is the market more frequently hitting. So maybe you decided you wanted to start with a 1.5% as your fixed take profit, but your backtesting data shows that the place that it is more likely to hit is actually 2.5. So you would be missing out on a whole extra 1% for every winning trade just because you just didn't mark it up right. So you should make sure that you are giving yourself the chance to determine the ideal take profit by making sure that you measure the full extent of every trade, even beyond what you set as your actual take profit. So here's just an idea of what this would look like. Every single vertical line you're seeing here that is yellow is an example of a trade that has been marked up to put into a back testing journal. So you can just see this is just a screenshot, a snippet of some of the back testing trades that we take, and then we then journal and break down for you guys. But you can see that every single one of those lines, so you can see there are a lot of them. And like I said, this is just a snippet, so you will see tons of them. And this is how you would mark it up. You would go along in the history of your trading view, and you would just mark up every time that the requirements for your strategy are met. This here is an example of a backtesting sheet that I wanted to share with you guys. This just has, I'll show you a bunch of trades that are listed just so you can kind of get an idea of how it works. You fill it out, and at the top here is your starting balance. This is your percentage gain on your account. That's the total of your account now with your percentage gain, win rates, wins, losses, the number of trades, and you can just see how it all gets broken down. London, mixed, New York, Asian. You can identify what is the best session to trade with this strategy, what is the worst session to trade. Even goes down into months over here where you can break down each session into months, like what month did what percentage gain. And that's the kind of stuff that you can get when you are using back testing and doing it correctly. This data is very helpful. Looking just based on this, just as an example, you can see like all of your win rates are fairly good, and you do have percentage gain on all of them, but Asian session is clearly the dominant session with a 63.55% win rate. So that would be the preferable session to be trading this, and you would probably want to avoid New York as your percentage gain isn't that great. So this is where like backtesting will help you to see where it is you should be focusing your strategy and your time and your efforts. A similar backtesting sheet is available for you guys that has been provided by the trading floor, and you guys will be able to have access to that as well as the how to use it video that Jay has created. I highly suggest that if you do not already have some sort of journal, that you do use it. Even if it is a proven strategy that we have supplied for you, you still should be doing your own backtesting to double check to make sure that your entries and your placement of stop losses and take profits are working out to still be profitable. So please make sure that you are always double checking a strategy with your own back testing, even if someone else has already proven it to be profitable. You have to do your own due diligence when it comes to trading, and it is ultimately up to you to be placing those trades. You should be getting that practice time in with that strategy before going live. Once you have a strategy or system in place and you have back tested it and you have determined that it can be profitable, the next step is to develop your own trading plan. So what is a trading plan exactly? It's your own customized guide to how you will trade your chosen market. This will include the rules for successfully executing your trading strategy. A plan is not a strategy, so please understand that those are separate things. First, you will create your strategy. Then you will backtest it, you will extract all of the necessary data, and you will take that data that you found and you will construct it into a trading plan that could be beneficial for you. You want to take out the highest win rates. You want to take out the highest percentage gains, the best days or the best months, the best sessions. And you want to put it all into a plan that would work for you personally around your lifestyle, that would make sense, but also give you the best probability and odds of being successful with that strategy. So how do you actually do this? You're going to take the details of your strategy, the trades that you have, use your images, the indicators, the criteria for the entry and the exits, all of that. All of that stays the same. It all goes into your plan as far as your rules that you need to set. You also need to know when and where you are going to be trading these, like which market specifically, what sessions you want to have it, what time of day, and what day of the weeks. So those would be things that you would break down based off of your data, and you would pull out all of the best numbers that you could get from that data and fill in those categories. And most importantly, make sure that your risk management plan is still there and it is being adhered to. You want to know how much are you risking. At this point, you can decide if you want to alter your risk management based off the data that you had gotten from back testing. If you feel that the percentage gain could have been better and maybe you didn't have a lot of losses in a row and the win rate is good enough, then you could up the risk that you take and you could risk 2% as long as you were comfortable that there weren't too many losses in a row. That's an example where you could up your percentage risk per trade to help your percentage gain on your account. Those are all the things that you will work through once you've finished your back testing and determined what is ideal based on your results for that particular strategy. I know someone will say, I don't need a trading plan. I'm just going to follow your strategies that you guys gave. You tested them. They look great. Cool. Let me go jump into a live market. Wrong answer. You still need a plan. Trading without a plan is like gambling because you are just trading without any sense of how it is that you should be entering or exiting, what days you should be doing it, what's the best times to do it. You're just blindly doing it based off of my data. And although that is helpful and you can use my data to create your own plan, you still need to formulate a plan around your own personal life and the days you can trade, the times you can trade, and how you are going to define your personal style of it. You need to be organized, methodical, and consistent in your trading. Your plan is like your blueprint to your daily trading. It really is a roadmap to success, so you need to be making your own version of it. Please feel free to use the data that we supply you guys with, all of the back testing we supply you with to help ease you into the plan. You don't need to go back test it all. You don't have to do that grunt work of it. We've done that for you. But as far as creating your individual plan, that will be up to you to do, and you do need to still do that step. It won't take long if all the back testing is done, but do not skip it. You need to know where, when, why, and how you are placing trades. That is important. So keeping a trading journal is important. We talked about back testing, but that's actually different than a journal. A journal would be using your future trades that you're taking, not the past trades. So that is just as important. It's a good way to provide you with evaluation of yourself. It helps to find factors that are affecting your trading and maybe your mindset even. If you're breaking your own strategy rules, maybe you're having FOMO with trades, maybe you're closing out too soon. All of these are things that happen when you get your emotions involved and you're in a live market. So it's important to have a trading journal where you can enter in the trades, enter in what happened during them, and then have maybe a little comment section where you can write oh, closed out too soon, would have hit my take profit. And that's okay. Be honest with yourself because that's how you get improvement. In order to improve, you have to be collecting continuous data, and that helps you figure out where you can refine the trading strategy itself. If there are changes that have been happening in the market and your strategy maybe isn't quite as effective anymore, that will also help you and save you from having to go all the way back and back test everything. You will have a journal now that you can just look at, and you don't have to go back and do all that work you did the very first time. It also helps you track your strategy performance, which kind of hits on the refinement point that I just said, but it will help you keep track without having to go backwards. And more importantly than anything, I think it really helps you track your growth, and that's important for a lot of people to see. You don't always feel like you're making progress in the beginning, but when you go back and reflect at your journals, you can see maybe you had a lot less trades. Oh, I had FOMO with this trade, or oh, I panicked with this trade. And as you start seeing that the emotions that were getting the better of you are starting to lessen, and you're starting to become more disciplined and trusting of your strategy. Or unfortunately, you may see vice versa. But the point is that you're journaling it and you're able to see what is it that's been happening for you, or when do you mentally do the best trading? When are you the best you at trading? When do you struggle with it? So all of these things are important. So even making a note on this comment section, just how did you feel that day when you traded, can help. You never want to trade when you're in a horrible mood, or maybe you're fighting with somebody, maybe you're extremely sad, or you just had a horrible loss and you're just mentally are in this revenge trade mode. All those things are important to be journaling so you know where were you at the time that you took that trade and how would that maybe have interfered with the result of that trade. The journal, like I said, is available on the trading floor. It is a combination of the backtesting / journal / calculator, so you can have it all up on one sheet. Now that you have created a successful strategy, you have a trading plan, and you have implemented great risk management with it. You have tested it, you have tried it on demo in the live market, and you have been journaling with it, and you're feeling pretty confident about yourself, and you're thinking, I want to start trading this, and I just don't have access to capital. I just don't have enough money to really make the money I want to make this a real profession for myself. What you can look to then are funded accounts or prop firms. Funded accounts are an option for trading with someone else's money. This is an option provided by the prop firms themselves. Basically, a company will give you the capital you want to trade, and they will provide that for you for a much smaller fee, and you will not be responsible for any losses on that account. If you violate a rule, you just lose the fee. If you make money above and beyond what the capital is that you have signed up for, any profits made above that, you will then get to keep. And typically there is a split profit. On average, it is usually somewhere between 75 to 90, meaning that you as the trader would get to keep somewhere between 75 to 90% of all profits made, and then them as the prop firm would get to keep the additional 25 to 10%, depending on their profit split rules. There are tons of prop firms out there. All the prop firms will put all the information on their websites. Make sure you read the rules and the regulations that they set. Most firms offer somewhere between 10K to 200K in funding. And they also may offer a scaling plan that will allow you to scale beyond 200K if you have been consistent for a certain amount of time. They do charge a fee for this, but in comparison to the amount of capital you are getting to trade with, the fee is pretty small. It can range anywhere from $80 for a 10K account as high as up to I think I've seen 900 or so plus for a 200K account. So there is a wide range of plans when it comes to these firms, and something that probably could fit majority of people's budgets. Most of them will allow you to trade the Forex market, the indices, metals, and crypto. Not all of them, so please make sure you do refer to their specific website to see what they do and do not allow to be traded, but majority of them will allow this. So I know you're thinking it sounds too good to be true. All I have to do is pay a fee and then they're going to give me money to trade. Where's the catch? It can't be that easy. And you're right. It's not that easy. There is definitely a catch. The catch is that most of them have evaluation / challenges that you have to pass. In order to be able to do this, you have to pass most likely 2 phases. Typically, phase 1 of that challenge consists of you having to get somewhere between 8% to 10% profit in a 30-day period. And the phase 2 would consist typically of having to get somewhere between 5% to up to 8% profit again in a 60-day period. You also have rules that you have to follow. So there are trading regulations that you have to be aware of, such as you may not be able to trade news events, or you have a set drawdown limit that you cannot violate, or a certain amount of profit loss. So the rules are very important to follow, because if you violate a rule, you will lose access to that account and you will have to re-sign up again and pay again for the account. So I highly recommend that you do not go for one of these challenges until you have done all the other steps I just talked about and you have practiced your strategy for at least 1 month. I really implore you guys to wait the 1 month and practice it for real. That is where you're going to see how you as a trader can handle the pressures of a live moving market. You don't have to do it on a live account, but do it on a demo account in a live market. Practicing your strategy to get the feeling and get used to how it's moving. A lot of these prop firms will offer a free version of their challenge that you can practice with to see if you could even pass before you go and invest your hard-earned money into them. I recommend that you do that before you actually put money out to purchase one of these accounts. They offer it for free. You should take advantage of it. Take the time, spend the 1 month that you need to see if you would be able to pass the challenge. If you're able to pass the challenge and you don't break any rules, then you could look at potentially purchasing one of these accounts. They are looking for the top 5% traders. Typically, only 5% of people who go for these accounts actually pass them enough to get funded. So keep that in mind and make sure that when you're going for these, that you're being strategic about it, that you're not just going in to waste your money, that you are going in to take it seriously, and that you have put in the time and effort prior to deciding to do this, knowing that 95% of people signing up at the same time as you are probably not going to make it through. So you need to make sure that you put yourself in a position to be in that 5% that passes. So some pros and cons about trading prop firms. For those of you who aren't really sure, like, why wouldn't I just trade my own capital? The reason that a lot of traders find prop firms appealing is because of the profits you can make back. So instead of trading your capital of, say, 5K, you trade a prop firm's capital of 100K. When you place a successful 1 to 2 risk to reward trade, risking 1%, you yourself on your 5K account can earn a capital of $100 if you win that trade, which is great. It's good money. However, if you're trading with a prop firm's capital of 100K, and you win that trade, you can then earn $2,000 for the same type of trade, the same risk, just higher capital. Because of that higher capital, people are more drawn to funded accounts. The benefits obviously are that it is a small fee to have access to more capital with the potential to earn a lot more money. And you're not risking your own money when you're trading a funded account. So say, for instance, you sign up and you bought a 10K account for $80. $80 is the one-time fee that you are sending for that, and then they give you access to a 10K account for you to trade. Now, let's say that you start the evaluation and you just bomb it. You don't know what happens, but like your emotions get the best of you and you're just a wreck. And you destroy the 10K account. Next thing you know, you look at it and it's like all the way down to like $1,000 left in it. You lost 9K of that 10K account. If this happens to you and you are trading with a prop firm account, you are not responsible for that loss of that money. All you will lose is the $80 that you invested into that account. That is it. That 9K that was lost, that's not your problem. You are not responsible for it. And you're all stressed out and you're panic trading and you're getting super drawdown and you're just refusing to believe that you're losing. And next thing you know, you have lost $9,000 on your personal account. You have truly lost $9,000 on your personal account, and that is your responsibility to handle. So that is the appeal to these prop firms, is to kind of have no obligation to them afterwards. Like, yes, you will lose your account if you violate a rule. And if you want to continue with them, you will have to repurchase another one. But you are not held responsible for any losses that are incurred beyond your initial sign-up fee. The potential drawbacks to this are that you must follow the firm's rules, which some of them can be quite strict and kind of hard to follow. And some of them include things like trading news. There is daily drawdowns. Most of them do have about a 5% daily drawdown. You're not allowed to draw down more than 5% of your overall account. And there is also potential for weekend limitations. Some of them will allow you to hold through a weekend. Some of them will not allow you to hold through a weekend. This could be a problem for you if you are a swing trader. So you would want to look into prop firms that are swing trader friendly and make sure that they would be compatible with your style trading. My last comment about funded accounts is just that there is no right or wrong. For some people, trading them will make sense and it will be the better direction for them to go in. And for others, sticking with your own personal account and growing your capital on your own and compounding it will be the better alternative. We do have access to compounding sheets or like pip challenge sheets that you will see throughout the Discord, where it can give you an idea of like how you can compound your lot sizes if you are somebody who's trying to build up a personal account. There is going to be a separate video explaining that and how you would go about using that sheet, so you can look for that as well if you are interested in working with your own personal account. So congratulations, you have made it through the entire beginner's course, from very beginner to intermediate to advanced content. I welcome you guys to the trading floor, and I am very excited to meet all of you in the Discord. There will be a mini quiz for my content as well that you will have to pass. But other than that, you guys, if you have any questions, please feel free to reach out to myself or Artie in the Discord. We are always happy to help you guys, and we welcome you to the Discord.